Hello, this is Alex Awari from ONG Tax and Accounting Services. So this video is going to be part 2 of the series that we just started on when and how your Social Security benefit and disability benefit are subject to federal taxes. And in this episode or this part 2 video, we're going to look at a single filer with provisional income between the base amount and the adjusted base amount. Now, in the previous video we looked at a single filer with a provisional income that was equal or below the base amount. So this video is basically progressing to a different form of situation where you could have a single filer with a provisional income between the base amount and the adjusted base amount. Like I said, the earlier one we did, part 1, we had the provisional income being equal or below the base amount. But in this case, we're looking at situations where your provisional income falls between the base and the adjusted base amount. Now, before we start, let me just give a quick disclaimer that this video is for educational purposes only and it's not meant to be a legal or tax advice. And if at any point in time you need a legal or tax advice, always consult with an attorney, a CPA, or an enrolled agent. In the other video, I did state that I sincerely sympathize with you senior citizens that has to deal with the kind of complications and difficulties and how Social Security taxable rules work, and looking at the demographic that these Social Security taxes cover. I mean, it covers senior citizens, it covers those on retirement, it covers wide population or wide demographic of persons who may be disabled and can't even read to comprehend what these rules are about. And so it's kind of disappointing when Congress set up the rules to be that complex, looking at the demographic it covers. But like I said in the previous video, Congress has set up the rules and it's just up to us as law-abiding citizens and taxpayers to follow what the rule says for now. Now, to start off, I'm looking at how and when your Social Security is taxable. We're going to look at a fact-specific issue, right? So we're going to look at a question we recently got from a single filer. So here's a question. The question says that the taxpayer said he's a single filer who is on retirement. During 2021, he received SSA 1099 reporting a net payment of $36,000 from the Social Security Administration. He also pointed out that he received a $2,000 tax-exempt interest income and then also a $10,000 IRA distribution. And he has basically posed 2 questions. And the first question is whether his Social Security benefit is taxable. And then if it is, how much federal taxes does he owe based on the information provided here? So now that we know the question, let's look at what the issue is and address the first question. The first question is whether his Social Security benefit is taxable. So we're going to start building some foundation here and giving you the rules surrounding it. Now, for the purpose of determining taxable portion of benefit, there is no distinction between Social Security retirement benefit and disability benefit. Now, what I'm trying to say here is that both Social Security retirement benefit and disability benefit are taxed the same way. So if you fall into a situation where you have to pay taxes, these 2 benefits are treated in the same manner in terms of taxes. Now, Section 86, which is the Internal Revenue Code that lays out the foundation for how Social Security is taxed, provides a 2-part formula to determine the portion of Social Security benefit that you should be including in your gross income, if any. The formula uses a base amount, and we're going to talk about it, and it also uses an adjusted base amount to determine the taxable portion of your Social Security benefit. Now let's look at the rules that establishes, number 1, your base amount, and then 2, the adjusted base amount. Now, Section 86C establishes all the base amount and the adjusted base amount. So for the purposes of this section, and I'm not going to read the full details of this code, but I know what I need from here. So if you're a single filer, your base amount is 25,000. Your adjusted base amount is 34,000. So keep these numbers in your head as we go through this video, because they're going to be very helpful in determining what portion of your Social Security may be taxable. All right, so we did go through the code, section 86C. Now let's summarize what the code says. Now, under paragraph 1A and 2A of the section 86C, Congress has established 25,000 as the base amount for single filers and 34,000 as the adjusted base amount. So we're just summarizing what we did in the earlier slide. And then we go on to say that 50% of your Social Security benefit, that portion, will be taxable if your combined income. Now, combined income is also referred to as provisional income. So in this presentation, we will show you how to calculate your combined income. So we just throw in another word that you need to be watching out for, which is a combined income. So far, we've mentioned base amount, adjusted base amount. We've also talked about combined income. So here it says that 50% of the portion of your Social Security will be taxable if your combined income is between 25,000 and 34,000. Now we say 50% is going to be taxable, but really it is not as easy as 50%. There's a whole lot of complications that goes into determine 50%. So we'll show you the complications, but when we say 50%, it's not that easy. 85% of that portion is taxable if your combined or provisional income exceed or is more than 34,000. And then once it exceeds the 34,000, then it means 85% of your Social Security is taxable. Again, when we say 85% of your Social Security is taxable, it is not just a matter of just taking your Social Security amount, your net benefit that you receive, and multiplying it by 85%. A lot more goes into that calculation. You probably may be doing the calculation wrongly and may be paying more taxes. So this video is going to walk you through the complications on how this 50% or 85% is determined. Great. So we've addressed what is a base amount. We know what is an adjusted base amount. We've heard about provisional income. So let's continue moving on to determine what portion of your Social Security benefit are taxable, especially when you're a single filer. So section 86A generally provides that gross income includes Social Security benefit in the amount equal to the lesser of 1/2 of the Social Security benefit received during the year, or 1/2 of the excess described in B1, in subsection B1. Now, what is in subsection B1? Subsection B1 directs that to the extent your provisional income exceed the appropriate base amount, up to 1/2 of such excess will be taxable. So we're going to look at the lesser of 1/2 of your Social Security, or to the extent your provisional income exceed the appropriate base amount, up to 1/2 of such excess is taxable. I know that's a lot, but we'll go through the numbers and show you what this is all saying. So basically, the calculation for this single filer based on the facts want us to figure out the lesser of this and that. To be able to figure this out, we'll have to look at what a provisional income is. Provisional income includes your modified adjusted gross income. That means that all of your other income from all sources. So it could be net self-employment tax, could be interest and dividend, capital gains, wages, pension, and so many other types of income that you receive. And then once you've been able to determine all the other source of income, include tax-exempt interest into it. Yes, tax-exempt interest generally is not taxable on the federal level, but for the purpose of figuring out your combined or provisional income, you have to include it in all these types sources of income we've talked about. So your combined income include your modified adjusted gross income plus 50% of your Social Security benefit. So these are the foundations we've laid so far. Now let's figure out the taxable portion and the amount of federal taxes due. We're going to apply this taxpayer's facts to the rules. Step 1, you're first going to calculate the MAGI. Your MAGI is modified adjusted gross income. When you're figuring out your modified adjusted gross income, you don't take any kind of deductions. You don't take credits. It's just all of your gross income lumped together. So you have 2,000 tax exempt interest plus the 10,000 IRA distribution gives you your modified adjusted gross income of 12,000. So that's the first step here. Now, step 2, we're going to calculate the provisional income. So this taxpayer's provisional income is 30,000. How did we get a 30,000? First, we have our modified adjusted gross income, which is the 10,000 IRA distribution plus the 2,000 tax exempt interest makes up 12,000. Plus 1/2, 50% of the 36,000 Social Security benefit gives us 18,000. So when you add 18,000 to the MAGI of 12,000, you get 30,000. And 30,000 here becomes your provisional income. So step 2, you have to calculate your provisional income, which we've done here. Step 1, remember, we have to know our MAGI. So we got to figure out our MAGI here, and then we moved on to step 2, calculating our provisional income. So your provisional income is basically going to be your MAGI plus 50% of the 36,000 SSA benefit you receive, bringing your provisional income total to be 30,000. So now we know provisional income. So keep that in mind. So far, we know our base amount for single filers, which is 25,000. We know our adjusted base amount, which is 34,000. And then we know our provisional income, which is 30,000. So let's move on. All right. So in step 3, we're going to determine the taxable portion of the Social Security benefit. And once again, we're going to apply Section 86A. It generally provides that gross income includes Social Security benefit in an amount equal to the lesser of A or B. This portion wants us to do some complicated analysis here. And then after we've done the complicated analysis and the calculation, we compare the values that we get from subsection A versus the one we have on subsection B, and then take the lesser of it. First, let's start with A here. Okay, let's start with subsection A. It says that 1/2 of your Social Security benefit received during the taxable year. So what was the Social Security benefit he got? He got 36,000. So when you multiply 36,000 by 50% or 0.5 or divide it by 2, you get 18,000. So far we have the value in A being 18,000. And then B is where the complication is. So follow me right here. We're trying to calculate B because whatever is the lowest between A and B is what we picked to be the taxable portion of your Social Security. So what does B says? B says that 1/2 of the excess of the taxpayer's provisional income over the appropriate base amount. So first of all, this talks about provisional income. So what is our provisional income? Remember, we calculated a provisional income of 30,000. How did we get a provisional income? And let's recall it. The 30,000 was as a result of adding your MAGI. Your MAGI was 12,000. And then we plus the 50% of your Social Security, which was 18,000. So 12,000 plus 18,000 gives you 30,000. So that's all good right now. Let's read the rules again. 1/2 of the excess of the sum of the taxpayer's provisional income over the appropriate base amount. What is the base amount for single filers? The base amount for single filers is 25,000. So if your base amount is 25,000 and your provisional income is 30,000, that means that your provisional income has exceeded your base amount by 5,000. 30,000 provisional income minus the base amount 25,000, you get 5,000. It also says that once we have the excess, we should divide it by 2 or we should multiply it by 50%. What is 50% of 5,000? That's going to be 2,500, and that's what we have here. Now, let's go back and read the rules again. It says that the portion of the Social Security that you need to include in your gross income is the lesser of A or B. So when we did A, we got 18,000. The final result in B, which is after figuring out the 50% of the excess between the provisional income and the adjusted base amount, we got 5,000, and then we multiplied by 50%, right? That gives us 2,500. So 2,500 here is the ultimate result or calculation you would get under subsection B. So when you compare 2,500 in subsection B versus 18,000 in subsection A, you realize that 2,500 is less, is lower than 18,000. So here the rules tells us to pick the lesser of A or B. So the lesser of A or B is 2,500. So 2,500 is the portion of your Social Security that's going to be taxable. Now, this is a great deal because you received a net benefit of 36,000 and you only get to pay taxes on 2,500. That's a good one. You know, when we say 50%, it's not as simple as 50% because if you're going by the 50% rule, you would have been paying taxes on 18,000, not 2,500. And that's why I said that some of these things are so complicated that, you know, looking at the demographic that the Social Security taxes cover, Congress should have made this law so easy for everyone to figure it out. But unfortunately, that's how the law works. And then you just have to go through some of this gymnastic and analysis to figure it out. All right, so let's recap. In subsection A, we got 18,000. Subsection B, we got 2,500. Because 2,500 is less than 18,000, 2,500 will be included in gross income for the purpose of computing taxable income. Now let's compute this taxpayer's overall taxable income. We know that modified adjusted gross income is 12,000. So we're going to subtract the tax-exempt interest 2,000 from it because tax-exempt interest is not taxed on the federal level. So when you have Maggie of 12,000, you take out the 2,000 from it and then you get 10,000. So now that we have the 10,000, let's also add the 1/2, the 50% of the Social Security benefit that we calculated under 86A subsection B that we did earlier on. We got 2,500. So we add the 10,000 plus 2,500. That gives us 12,500 adjusted gross income. All right. So if we assume that the standard deduction for 2021 is 12,550, then the taxable income is going to be 0 because 12,500 AGI minus 12,550, because the standard deduction is higher than the AGI, the taxable income itself is going to be 0, and then he's going to pay 0 taxes. Now let's look at how the worksheet works, how it all comes together. And this worksheet is basically simplifying what we've gone through, the presentation we've gone through so far. It started with the net benefit of 36,000. Here it's trying to figure out the provisional income. And so it takes 50% of the 36,000, which gives you 18,000. And then it then takes the IRA distribution and then the tax exempt interest, all of them giving you 30,000. When you have the 30,000, we next go to the base amount. The base amount we have here is 25,000. So here the system is just trying to tell us that the difference between the base amount and the provisional income is 5,000. That's all good. Now, Law 11 basically wants you to figure out the difference between your base amount and your adjusted base amount. So your base amount is 25,000. Your adjusted base amount is 34,000. So the difference is 9,000. And then here it tells you to enter the smaller of the 9,000 or the 5,000. And then once you have that, it tells you to divide it by 2, which is 50%. If you follow the logic, you're going to understand how they got to the taxable portion of Social Security to be 2,500. So that's all good for now. Once we have the taxable portion, we're going to go to how it goes on the 1040 form. So if you look at it, on the 1040 here, you have tax exempt interest of 2,000. It's here on line 2A, but it's not transferred over to 2B because tax-exempt interest is not taxable on the federal level. And then you also have pensions, which is things like IRA and 401k are taxable, and he received $10,000, so you can see it here. You have the Social Security benefit showing on 6A as $36,000, but only $2,500 is taxable. So when you bring it all of them together, the only amounts that are taxable is the pension or the IRA distribution, and then the $2,500 portion of the Social Security. So that gives you total adjusted gross income of $12,500. Now, because the standard deduction here is higher than the adjusted gross income, you get a zero taxable income. And when you have zero taxable income, it means you pay zero taxes. So I hope this helps you guys out. Please like, share, subscribe, or put your questions in the comment or send me an email, and then we'll talk more about you and your taxes. Thank you and have a good day. Bye.